to today's report, the 6th of December 2024. So what's in store for us today? Let's see. Right, today I'll talk about the Fed highlights economic resilience and cautious approach to rate cuts, right? So at the New York Times DealBook Summit in New York, US Federal Reserve Chair Jerome Powell remarked on the economy's unexpected strength compared to earlier forecasts. He emphasized that the economic outlook has shifted since September when the central bank began reducing interest rates, right? He also suggested support for a more measured approach to future rate cuts, signaling alignment with a cautious bloc of Federal Reserve policymakers. Now, obviously, this is because some of the Fed policymakers, they are not into this. They want a different outlook. But in general, the echo of Fed Jerome Powell represents the majority of what the Federal Reserve policymakers are looking at. Okay, so in his address, Powell reiterated themes from his mid-November remarks, where he advocated for careful deliberation regarding interest rates adjustments. He stressed the importance of not rushing policy decisions, allowing for a balanced and data-driven approach. Now, this is often been criticized because it's just like every time there's nothing much to get from his speech because it's still the same. Everything is data-driven, data-driven, data-driven. Okay. Powell also highlighted the need to remain flexible amid growing economic uncertainties in the coming year, particularly some concerns that progress on inflation has stalled and broader economic policies remains in flux. So these were what he talked about in the recent DealBook Summit. Now, looking at the labor market overall, it is the central concern of the Fed. Now, Powell underscored that labor market as a primary focus for the Federal Reserve, noting that September's half-point rate cut was designed to send a strong signal of support should labor conditions deteriorate further. Now, the labor market's performance remains critical, with fresh data on employment due to be released today and updated inflation figures expected next week. Now, these indicators will play a pivotal role in shaping the Fed's upcoming decisions, both at its final policy meeting at the end of the year and in crafting its 2025 outlook. Now, so far in inflation, we're going to focus on inflation stalling above target. Now, inflation continues to be a thorny issue. A key gauge, the personal consumption in expenditures, i.e. the PCE index, which exclude volatile food and energy costs, has remained stubbornly elevated, ranging between 2.6% and 2.8% since May. Now, this level significantly exceeds the Fed's 2% target, fueling concerns about whether sufficient progress is being made to curb price pressures, especially when Donald Trump could probably resume his trade war when he comes into office next year in January. So at the end of the day, I think it's this upcoming policy decisions and market expectations. The Fed's next rate decision scheduled in 2 weeks is highly anticipated. Current market projections place a 73.9% likelihood that the Federal Open Market Committee, or the FOMC, will opt for a quarter-point reduction in its key borrowing rates. Beyond this meeting, there is a 62.2% probability that the Fed will pause rates adjustments during the January meeting, and you can see this from here. So it's like 73.9%. They're gonna bring the rates down. But when it comes to the next one, the January one, it looks like they're going to pause it for 1 month. Okay, and then later on, if they want to cut it, it will be here for March and May. So that's the thing. We need to have a look and understand, how is it changing. So markets also anticipate several additional rate cuts in 2025, reflecting expectations of gradual easing cycle to address economic uncertainties and support sustainable growth. Now, going forward, this will be a very important chart to look at the probabilities right over here. But that beckons one question: if the economy is so good Why do you still need to cut rates? Okay, so there must be something inside there that we need to study, especially the labor market, because at the end of the day, if rates are high and the labor market is not able to sustain, then people are not able to pay their loans and whatnot, right? And this will be a big issue. So let's see, especially when Trump introduces this trade tariffs, right? There's going to further give headache to the overall market in the short term, and that's not really that good. Okay, so these are the things that we need to study and study in detail. Don't take everything at just whatever you see. There will be, ask questions, things like what I mentioned just now. If the market is so good, why do you need to cut rates? Kind of thing. So, approach all this news uh carefully, and we'll see from there. Okay, so whatever it is, right now the overall stock market is making newer highs, but with every high, the risk of a correction is there. Okay, it might be a shallow one, it might be a deep one, but nevertheless, we do expect corrections. And when we come to charts in a short while, you'll be able to see the possible areas that price might pause temporarily for the S&P 500 and the Nasdaq as well. Okay, so with that, that's the report for today.